Hello, it's a lovely morning from here in Delhi and hope each one of you are absolutely fine. So, till up to this particular point, we have in fact gone through almost over all the what we call guidelines as far as theoretical part is concerned. We in the last session were discussing the accounting, what we call methodologies with respect to consolidated financial statements. We are going to continue with that. So, coming directly to the business end, we start the session now. This is the question actually which we did in the last session. In fact, we are going to keep this question once again. This question is starting from here. P and S Limited, following are the balance sheet of P and S Limited, and I have written very clearly that S Limited is the subsidiary of P Limited. Balance sheet date is 31st/3/21. This is the question which we did in the last session. If some of you haven't written it, I would love you to actually note down as soon as possible. First of all, we have written non-current asset. Under it, there are what we call property, plant and equipment, and even under property, plant and equipment, we have written plant and machinery 10 lakhs and 8 lakhs. Besides, we have financial assets. Financial assets, investments in 3,000 shares of S Limited 7 lakhs, and then current assets 5 lakh and 11 lakh, total 22 and 19. Besides, towards the liability side, that is equity and liability, we have items. Equity, share capital 10 lakh and 5 lakh, other equity time, and again I have been telling you and that it actually simply refers to reserves and surplus. So profit or loss account is the item under it, Prof 4 lakh and 5 lakh, then non-current liability is 5 lakh, 4 lakh, current liability 3 lakh and 5 lakh. This is the question, we will still continue with that. The question which we did last time, in the additional information I had written that P Limited acquired control on 1/4/2020. But now I'm going to change this data. That means the question will remain same here till up to this particular point, and now I'm changing the additional information, correct? So, same question, same data, same balance sheet, and now we are going to actually add something to it. Now you write in the additional information, correct? Additional information. There are lots of sheets, sometimes they create problem. Just let me pluck out some sheets from here, because sometimes it becomes a little bit troublesome for us to write the things. Okay, now I think it's okay. So additional, it's pretty cold out here in Delhi today, so that's why we are feeling, fingers are feeling almost like bloodless. So additional information. Under the additional information, now I am writing P Limited acquired control. P Limited acquired control. P Limited acquired control on 30th of September 20. I think in the last question dates were 31st/3/21. That means starting date was 1/4/20 and closing date was 31st/3/21. So midway during the accounting year we acquired the control. P Limited acquired control on 30th of September 20. Remember one thing. And further information, profit and loss or other equity, profit and loss of subsidiary company, in short form I have written subsidiary company stood at rupees 2 lakhs on 1/4/20. So balance in the P&L of subsidiary as on 1st of April 20 happens to be 2 lakh. Almost same question. Everything is same balance sheet except for this particular line. In the last question which we did, control was acquired in the beginning of the year. So now here in this particular question we are going to analyze when the control is acquired midway. It could be any date, not exactly midpoint, it could be any date. That means during the accounting year. So if you remember the points which we discussed in the last session, First of all, what we need to do is to actually analyze the accounting period. So that's the point actually I'm going to write here. Analysis of accounting period. Analysis. The solution now starts. Analysis of accounting period. Of accounting period. Analysis of accounting period of that is S Limited, subsidiary limited. Correct? So first of all, we need to analyze the accounting period. In order to analyze the accounting period, all you need to do is first of all, calmly draw a line or stretch a line. Accounting year is beginning from 1/4/2020 and ending on 31st of 3/21. Correct? This is the range of the accounting period. Once you have drawn the accounting period range, now just have a look which exactly is the date on which control was acquired. So control was acquired somewhere here, that is 30th of September 21. On this date, control was acquired. Date of control, DOC, or date of acquisition, whatever you may like to write. This is the date of control. Why we are analyzing the things? By now you should be absolutely familiar with the fact the basic purpose and hidden objective is we want to segregate the accounting period from the perspective of the holding company, that is parent company. Correct? So we want to actually segregate the accounting period of subsidiary company from the perspective of parent company. In fact, everything is being done from the perspective of the parent company. You need to keep that into your account. That is very important. So basic purpose is to know what exactly is the portion which relates to pre-acquisition period and which portion of the current accounting period relates to post-acquisition period. So period ranging from 1/4/2020 till up to 30th of September 21 will be considered as pre-acquisition period. That is period preceding the date of control. And similarly, period which falls after the date of control will be considered as, considered as post-acquisition period. Correct? So once you have done that, now the next step is to know the controlling stakes. We call it degree of control. It is not necessary that you have to write degree of control. You can write controlling ratio. Degree of control. We want to know the stakes of parent and of course the outsiders known as non-controlling interest. In order to know that, first of all, we need to know the number of shares of subsidiary company. Number of shares. This is what you need to write. So number of shares of S Limited. You know the total share capital of S Limited happens to be 5 lakh. And one share is of rupees 100. So which means total number of shares of S Limited 5,000. Out of this 5,000, we know that P Limited has invested in 3,000 shares. So parent share P Limited held by P Limited. Out of 5,000 shares of S Limited, P Limited holds 3,000 shares. And held by outsiders known as non-controlling interest in the hands of outsiders, there are 2,000 shares, which means as far as degree of control ratio is concerned, that happens to be 3:2 between what we call P Limited and S Limited and non-controlling interest, sorry. In the last session, we talked at length the significance of what we call having stakes with us. it reflects that in the total net assets, and net asset is also referred to as equity, and equity is also referred to as share capital plus other equity. Share capital plus other equity means profit or loss, general reserve, or for that instance any reserve. Is it clear to you? So it means whatever share capital of subsidiary company is there and whatever reserves are there, 3/5 of that belongs to parent, while 2/5 is actually, you can say, belongs to in fact non-controlling interest, isn't it? So once the degree of control is assessed, the next part is analysis of other equity. Analysis of other equity of course of S Limited. In the example, if you look at under other equity, there is only one item, profit or loss. So basically we are analyzing profit or loss of S Limited in this particular question, correct? So in order to analyze, I will write in bracket profit or loss. Had there been some more items, say general reserve, we would have had in that case actually even gone for yet another step to analyze the same. So in order to analyze the same, first of all, what I am going to do, see here, I am going to stretch a line once again. After stretching the line, then what I am going to do, I am going to write the dates 1/4/2020, beginning date, and of course the ending date of the current accounting period, 31/3/21. Once I have analyzed that, then I will look into the balance sheet, into the column of S Limited. Look into the balance sheet towards the liability side, into the column of what we call, as I said, subsidiary company, in the row of other equity. Under other equity, you find there is profit or loss account. Now, what's the amount over there? Amount over there, as you can see, is 5 lakhs, which reflects that on this date, subsidiary company is having a balance of 5 lakh in the profit and loss account. Is it? Right. Now, in the additional information, it is given to you that P&L balance of subsidiary company in the beginning is 2 lakhs. We had analyzed all this even when we did the first example. This is example 2, in fact, which I am doing here. Correct? So, I will write here example 2. I haven't written so far. Example 2. Same data, but additional information is different. Correct? So, after you have written the closing balance of subsidiary company and the opening balance, then you are now in a position to know how much subsidiary company has earned in the current accounting period. So in the current accounting period, as we know, subsidiary company must have earned, just wait, difference between 2 lakh and 5 lakh obviously happens to be 3 lakhs. This 3 lakh, remember one thing, will be termed as profits earned in the current accounting period. Current accounting period, sometime I may refer to as during the accounting period. Please remember this. I may refer to current accounting period as during the year period. Whenever I would say during the year period, you automatically construe it that I am referring to what we call current accounting period. So in the current accounting period, we may conclude that subsidiary company must have earned 3 lakhs. In the first example, control was acquired in the beginning, but here the control has been acquired as at 30th of September 21. So in this case, these profits which have been earned by subsidiary company from 1/4/2020 till 31st/3/21 cannot be considered as post-acquisition profit, because we know that out of this current accounting period, first 6 months are basically pre-acquisition period, as we saw in the first step. Similarly, profits earned in the 6 months after the date of acquisition will be considered as post-acquisition profits. So these are the profits which the subsidiary company has earned from this particular date till this date. So now I will have to divide, because in this question, control has been acquired midway during the accounting year. So whenever control would be acquired, correct, midway, so in that case, you may need to actually Segregate even the profits earned during the current year into pre and post period. So out of this, I may say first 6 months profit will be considered as, these are 12 months profit, so first 6 months profit will be considered as pre-acquisition profit, isn't it or not? So 3 lakh into 6 by 12, that is 1/2, will give me 1,50,000. These are pre-acquisition profit. I have written pre. And of course, the profits of the later 6 months, that is period falling after the date of acquisition, will be considered as post-acquisition profit. Those among you who have gone through the first session, and if you haven't, I would love you to actually go through it before you embark upon this one, because you won't be able to comprehend the things as easily otherwise. So we know that pre-acquisition profits of subsidiary company from the perspective of the parent company are considered as capital profits. I am simply writing as C just to denote it that these will be considered as capital profit. These will be considered as revenue profit. Besides the profits which are appearing on 1/4/2020, as I told you even in the first session, that these profits must have been earned last year itself, because these profits are nothing but the balance brought forward. So these profits have already been earned prior to the date of acquisition. So these profits, obviously 2 lakh, will be considered as capital profits. So out of 5 lakh, we may say 2 lakh plus 150, 350 will be considered as capital profits, while 150 will be considered as revenue profits. We need to break down into two parts the profits of the subsidiary company into capital and revenue. For the same, we need to find out how much profits have been earned by subsidiary company in the pre-period, while how much profits have been earned in the post-period. Profits which relate to pre are considered as capital. Profits which relates to post are considered as revenue profits. Once this step is done up with, now we are going to move over to the next step. Under the next step, actually, we will see in the upcoming questions which we'll solve, we will definitely dispense with this step. To be very honest with you, this step is not at all needed, but for the time being, because these are initial stages, and once you become deft in it, then only we will proceed over to that particular part. However, after you have done up with this particular step, as I said, now we are going to move over to the fourth step. Under the fourth step, actually, what I am doing, I am not doing anything new. I am simply actually putting up this information in a tabular, what we call form. So I will write here table showing pre, post, other equity. Other equity is nothing but profit and loss account. Other equity of subsidiary company. In order to prepare this table, first of all, in the first column I write details or particulars, whatever you may like to write. I am accustomed to writing details, so details you are going to put. Then in the next column you simply write amount. In yet another column you write parent. Keep in your mind their stakes 3/5 and non-controlling interest, that is outsider's claim we call it, 2/5. Correct? Now here I write capital profits first of all. What we mean by capital profits, basically, capital profits in the context of consolidated financial statement, profits of subsidiary company which have been earned during the pre-acquisition period. So capital profits, see here what I am writing. A, opening balance of P&L. Opening balance of P&L. Opening balance of P&L, what does it mean? It means P&L balance as on 1st of April 20. We know that the balance of subsidiary company in the beginning is 2 lakh, and these are entirely of capital nature because these profits have already been earned in the last year. So 2 lakhs. I will write here 2 lakhs. Now I will calculate shares. My share will be, mine means P Limited, 1,20,000. Share of non-controlling interest will be 80,000, isn't it or not? 2/5. So out of this equity, when I say equity, you know now what I am referring to. Out of this equity of 2,120,000 belongs to, in fact, P, and rest belongs to non-controlling interest. Then I write, see here, pre-acquisition profits, pre-acquisition profits, pre-acquisition profits. Whenever I would write word pre-acquisition profit, even these are pre-acquisition profit, no doubt about that, because these profits have already been earned in the last year. Pre-acquisition profit, when I say, it would mean pre-acquisition profit out of current year's profit. Out of current year's profit. Well, I am going to write, but I am going to write only once. From next time, you need to keep track of it. Out of current year's profit. Out of current year's profit. Out of current year's profit. Is it clear to you? So current year's profit total were 3 lakh. Out of that, 150 related to first 6 months, which is pre-acquisition period. So that is why even 150 will be considered as capital profits. Is it clear to you? Now out of 150, my share will be 90,000, 3/5, and share of non-controlling interest will be 60,000 without an iota of doubt. Correct? Then you have written A, capital profits. Then you write B, revenue profits. Revenue profits. Correct? Revenue profits. We know what we mean by revenue profits. Profits which relates to post-acquisition period. So I will write here post-acquisition profits. Whenever I would say post-acquisition profit, you automatically add to it out of current year's profits. So post-acquisition profits. Post-acquisition profits out of current year profits once again are 1,50,000. So we are going to put up here 150. Okay? Then out of that 90,000 will obviously be mine share and yours will be 60,000. That's all. Same information you have put up in a neat manner, in a tidy manner. Correct? Now, you tally your this amount, capital profits. It is 3,50,000. It also means, remember one thing, this 3,50,000 also means equity on the date of acquisition. Equity, I'm writing here, although it is not needed, equity on the date of acquisition. You have to keep in your mind. This is equity on the date of acquisition. Out of 350, we have already computed our share. That is 2,10,000. Isn't it or not? And share of non-controlling interest is 1,40,000. Similarly, this is post-acquisition equity, correct? This is equity, changes in equity, you can also write this way, changes in equity, 1,50,000. Changes in equity after date of control is nothing but revenue profits, out of which your share is 90 and share of non-controlling interest holders is 60,000. Is it clear till up to this particular point? I hope that each one of you are able to comprehend the same. So once we have completed till up to this particular point, the next step becomes quite easy. That is fifth one, that is known as goodwill or gain on bargain purchase. Goodwill or gain on bargain purchase. In the last session, I talked about this particular point at great length where I did tell that traditionally it is quite easy. As per IFRS 3, it is not, I shouldn't call it complicated, but it is not as easy. It's not as easy because it is quite new and you haven't yet become acclimatized to this methodology. But anyway, problem is that we have to learn calculation of goodwill or gain on bargain purchase in the backdrop of IFRS 3 guidelines. But just to make sure that you comprehend it quite well, first I am going to calculate through traditional method. Although it is not needed nowadays, yet just to make the things more clear, traditional method. Under the traditional method, calculation of goodwill or capital reserve, because under traditional method we used to call it goodwill or capital reserve. Under traditional method it is easy because all we need to do is to just pick up the investment, how much amount we have invested to acquire the control. Investments also indirectly means price paid by parent to acquire the shares. So how much price you have paid to acquire the share, that is written over there in the question. In order to acquire 3,000 shares, you paid 7 lakh. When you are making the investment in the shares, you are acquiring the stakes in the equity of that particular entity, in the investee entity, which happens to be your subsidiary. So this is your capital expenditure. So you need to know when you made this investment. Obviously you made this investment on 30th of September. That is on the date of acquisition. Once you have made the investment, you need to know on the date of acquisition, due to this capital expenditure, what capital benefits you drove out. You drove out capital benefits. One, actually we call it share in equity. You have to learn these terms, share in equity. And don't let it escape out of your memory that equity simply refers to share capital plus other equity of subsidiary company. Of course, I am referring to. So what share you got in the equity on the date of acquisition? On the date of acquisition, share capital, because it never changes, share capital balance is, as per balance sheet, is actually 5 lakh. But this balance must have been also same on the date of acquisition. So on the date of acquisition, share capital was 5 lakh and you acquired 3,000 shares. So 3,000 into 100. So 3 lakh worth of share capital you acquired. So share in equity, equity comprises of a share capital. So out of 5,000 shares, you acquired 3 lakhs worth of share, rupees 3 lakh worth of share or $3 lakh worth of share, whatever currency you would like to use. Correct? Besides, on the date of acquisition, you need to know, because this investment was made on 30th of September. On that date, you are going to compare actually, due to this investment, whether you are at loss or at gain. So you need to know on that date what you acquired. You acquired share capital, and on that date, the equity was 3,50,000. The equity was 3,50,000. Remember one thing, equity was 3,50,000 of subsidiary, out of which your share is 2,10,000. So you will call it share in equity, that is share in share capital, and share in other equity. I will call it other equity. Other equity simply means capital profits. Correct? So in the other equity, you got a share of rupees 2,10,000. So by making an investment of 7 lakh, you earned benefits, you can say in a layman's language, equal to 5,10,000. So ultimately we shall conclude that expenditure was high, benefits are less, we paid more. So whenever we paid more to acquire something, it is a capital loss. Why? Because we are talking about capital things. It is a capital expenditure, these are capital benefits. So it is a capital loss, and capital loss is termed as goodwill. So that is why I will write here goodwill to the extent of 1,90,000. But this is traditional approach. Under the traditional approach, things are quite easy. We have to just compare the what we call investment. We need to know actually how much share capital we acquired at par value or nominal value, and what is our share in the capital profit, which you can easily gaze down from this particular table. This is your equity or the profit and loss account balance or capital profits on the date of acquisition. On this date, your share out of that is 2,10,000. That's all. However, as same results will have to be driven in the light of what we call IFRS 3. Remember one thing, calculation of goodwill, even though we are doing IFRS 10, but at the same time, concurrently in the entire chapter, we may need the help of IFRS 3 because calculation of goodwill is governed by what we call IFRS 3. So, I will write OR and I will write IFRS 3. Under IFRS 3, how we are going to actually compute the amount of goodwill. In order to compute the goodwill, IFRS 3 states that we need to know total net identifiable assets, of course at fair value, on the date of acquisition when we acquired the control. So, first of all, we are going to here write a net identifiable assets, net identifiable assets, net identifiable assets, net identifiable assets, correct, on the date of control, DOC, of course at fair value. Now, two problems concurrently will arise here because it will never ever be given to you in a crystal clear manner, especially under such comprehensive questions wherein you would be asked to prepare the consolidated balance sheet. Under such questions, you will never ever be given net identifiable assets on the date of acquisition where so and so. So you need to keep the theoretical discussion which we have had in the last 2-3 sessions. I have told you and almost hammered it into your mind that net assets, first of all, try to grab the meaning of net asset, forget about identifiable for a while. More or less, this word is not going to pose any problem in this particular chapter. However, under business combination, we need to keep track of identifiable. Net assets, as each one of us knows very well, that asset minus liability refers to asset minus liability. An asset minus liability is nothing but it is the equity. If after subtracting from the assets liabilities, what I will be left, it belongs to owners, that is why it is known as equity. So we know that basically net assets means equity, and equity means share capital plus reserves. Now problem is that because this is the balance sheet I am having, where the question I wrote, just I will bring it to your notice once again. This is the question, correct? Share capital is 5 lakh. Unfortunately, or the problem is that this balance sheet is on 31st of 3/21. Actually, just by having a look over the balance sheet, I may say, or I may be tempted to say that net assets are 10 lakh. Actually, I am not wrong, neither you. But the problem here is that we need the equity on the date of acquisition. So how to draw out? We know that equity is share capital plus other equity refers to reserves and surplus. So even in the last session we talked about it. We know that, just pay attention, net assets basically means assets minus liability. Assets minus liability is nothing but equity, and equity is nothing but share capital plus other equity. Equity is nothing but share capital, SC I am using the word, plus other equity. Please keep track of these short forms. I know whatever balance of share capital which is existing on 31st 3/21 must be the same on 1/4/20th. Quite obviously, because share capital hardly changes. If it would have changed, the information regarding the same would have been given in the question. So rest assured that you shall always presume that whatever closing balance of share capital is there, that was also the balance in the beginning. Because we are interested in finding out net assets on the date of acquisition. In fact, here the date of acquisition is 30th of September. So you presume that share capital on date of acquisition was same as it is at the last day. So share capital on this day is 5 lakh on 30th September 2020. And we also know the equity on the date of acquisition. I'm not talking about equity in the beginning. I'm talking about balance and equity on the date of acquisition, which you can just have a look over here. The solution you have just done, the table which you made, correct? This is the table you framed out actually. So here, this total 350, opening balance 2 lakh and pre-acquisition profits combinedly will give you equity on the date of acquisition 350. All in all, the total of capital profits is nothing but equity on the date of acquisition, and here I have written also, correct? So now we are in a position to say that other equity on the date of acquisition is 3 lakh 50. So now we can easily find out net assets on the date of acquisition. So net assets on the date of acquisition will be equal to 8,50,000. Is it clear to you or not? So 8,50,000 is the amount of net identifiable asset. 8,50,000. This is the amount of net identifiable assets on the date of acquisition. On the date of acquisition. Is it clear to you or not? As per IFRS 3, in order to compute the goodwill, or for that instance gain on bargain purchase is nothing but your capital reserve. What you need then? After having computed net assets, and one more point if you allow me to. Actually, IFRS 3 states that it must be at fair value. Problem is that in the comprehensive question, it might be given, it might not be given. Suppose the question states very clearly the fair value of net identifiable assets on the date of acquisition is this much. In that case, I would have directly written that particular figure. No problem would have arisen. However, question would hardly ever give, especially in the comprehensive questions I'm talking about. Correct? So, you presume, because IFRS also states, it provides us a leeway that in case the fair value is not given, we can consider the book value, or should we presume that values which are written in the books are on par with the what we call fair values. So we shall presume that this value is also the fair value of the net assets. Is it clear to you? Just to confirm the guidelines of the IFRS 3. Then we are going to compare it with, in fact I am going to write here less. Many people don't understand actually why we are subtracting it. IFRS 3 states that you will subtract non-controlling interest. Now what will be the non-controlling interest on the date of acquisition? Non-controlling interest on the date of control. On the date of control I am talking about. So non-controlling interest, first of all, what does it show? It shows the share of non-controlling interest in the equity on the date of acquisition. So on the date of acquisition, as we know now, the equity balance happens to be 8,50,000 because this is equity. So 2/5 of 8,50,000 you will compute now. This will deliver you the stakes of non-controlling stakes worth of non-controlling interest. Correct? If you allow me to use calculator, 8,50,000 into 2 divided by 5, it gives 3,40,000. Indirectly it means out of 8,50,000 worth of net assets, 3,40,000 belongs to non-controlling interest. Out of 850, 240 belongs to, just excuse me, sorry. Sometime it becomes a bit problem actually when I'm recording this class. Problem is that there are some queries which we need to actually keep on attending, and anyway, so non-controlling interest on the date of control was 3,40,000. So what does it suggest? It suggested out of 8,50,000, 3,40,000 worth of net assets belongs to non-controlling interest. If I subtract 340 from 8,50,000, I will be left up with 5,10,000. Indirectly it means you are not supposed to do it in the examination, just to make the point more clear. By subtracting this from here, in fact, what we are doing, we are trying to find out what portion of the net assets or equity basically are going in the hands of the parent. So we can say by making our investment, we are deriving a benefit of 5,10,000 only. Correct? So we will again subtract now. What? Consideration. Consideration is nothing but the amount which you pay to acquire the control. Consideration. Now, consideration is nothing but investments. Although you will have to write only consideration, this is the term which is used by IFRS 3. Now, consideration amount. Please pay attention now. Consideration. We know that consideration is 7 lakh. Just compare these two figures now. Correct? You are getting a benefit of 510. You are making a payment of 7. That means you are making extra payment. You are getting lesser assets. So net is your 1,90,000, which reflects the loss, capital loss incurred by parent, and that is known as goodwill. That is how goodwill shall be computed, as I said, when we shall do it in the light of IFRS 3. Is it clear to you? I hope you are able to understand. Similarly, next step, this was the fifth, now the sixth one, non-controlling interest. Non-controlling interest. In order to compute the non-controlling interest, we need to write share in equity on the date of acquisition. On the date of control, share of equity can be seen very easily from this particular step itself. We know that on the date of acquisition, equity is 8,50,000 and non-controlling interest is 3,40,000, so I will write 3,40,000. Equity, remember one thing, includes share capital and reserve. It also means stakes of non-controlling interest in share capital and of course the profit existing on the date of acquisition, 3,40,000. Correct? Now, we will write here plus what? Share in changes in equity. Share in changes in equity. Remember one thing, equity has got two elements, share capital and reserve. And share capital would not change. Change could take place only due to other equity. Other equity here stands for profit and loss account. So indirectly it means share in changes in equity. And here, share in changes in equity, we are referring to only post-acquisition. Only post-acquisition. Is it clear to you? Look into the table. This is your post-acquisition equity. And here the share of non-controlling interest is 60. You simply write here 60,000. This is how you are going to, in the light of IFRS 3, this is how you are going to actually compute non-controlling interest. So 4 lakh. Is it clear to you? Now, after having completed sixth step, we need to take care of seventh one, consolidated financial statements. In order to prepare the consolidated financial statement, I will have to keep the question in front of me. First of all, this was the question, correct? The first item is actually not property, plant and equipment. In fact, let me write first of all assets. Then I will write here non-current asset in the short form. I will write A, property, plant and equipment. Under property, plant and equipment, there are many assets. In the question we have been given plant and machinery. Nothing much in it. You take the figure of 10 lakh appearing in the column of parent limited. Simply add to it the figure which is appearing in the column of S limited in the same row. So plant and machinery of P limited is 10 lakh. Of S limited is 8 lakh. So this 18 lakh shows plant and machinery of the group. Is it clear to you? This plant and machinery is of the group. Now, then we have in this case financial assets. Financial assets. Division 2. We are following. Remember one thing. Financial assets. Under the financial assets, as you can see, there are investment. If you remember, in the last session, we talked about this particular fact that investment, because it is a transaction between the group entities, such transaction will have to be eliminated, so it will not find place in the group statement. Is it clear to you? Group statement will not carry any such transaction, correct, which is taking place between the two entities of the group. So here the group entities are parent and subsidiary, and parent has made the investment in subsidiary. It is a transaction of this sort, so we are not going to actually put up in the balance sheet. We have eliminated it. Then there are current assets too. Current assets. Under the current asset, in the column of P limited, you find 5 lakh and 11 lakh current assets are there of subsidy. So now total group current assets will be equal to 16 lakhs. Whenever you will prepare the balance sheet, before you tally, just make sure not to actually forget writing intangible asset. I am writing it with red pen, correct? There is a goodwill in this case, so I will write goodwill 1,90,000. I am writing it with red pen. 1,90,000 is goodwill also. Now you are in a position to finish it off, whatever balance is there. Now we move over to equity and liability side. Under the equity and liability side, first item we are going to pick up will be equity. Equity has two elements. Remember one thing, this is share capital. Also remember the discussion of the last session, wherein I especially stressed over this particular fact that as far as share capital is concerned, only share capital of parent will appear here. Share capital of parent is 10 lakhs. It means share capital of subsidy will not be written down over here. Reason being, it's very simple. Because parent has invested in the share capital of the subsidiary, that also constitutes an intercompany transaction, and it will be intercompany transaction means transaction between the group entities, so it will be eliminated. Then we shall write here B. We will write here other equity. Other equity stands for reserves in surplus. Please don't let it escape. Under the equity, we shall write consolidated P&L. Okay, let me write in full. Consolidated P&L. Under consolidated P&L, what we are supposed to put up the figures. See here, first of all, take the figure of P&L of parent limited, which happens to be 4 lakh in this case. 4 lakh. Now add to it share of P limited parent in post acquisition P&L. Look into that table. The post-acquisition P&L is 150, out of which 90,000 is our balance, correct? So 90,000 we are going to add it because it is of revenue nature for us. 4,90,000, now we are going to present it over here, correct? Similarly, now the next item which we are supposed to write here actually is non-controlling interest. Non-controlling interest is 4 lakh even in this question. If you remember in example 1, when the control was acquired in the beginning, even in that case non-controlling interest was 4 lakh. Non-controlling interest will not change due to changes in what we call date of control. Remember one thing. Now there is another item, non-current liability. Non-current liability, 5 lakh is of parent and 4 lakhs of subsidiary. Line by line addition, that is 9 lakh. Then finally we have in this case current liability, and current liability of parent happens to be 3 lakhs, while of subsidiary it happens to be 5 lakh, total 8 lakhs. So this is how you are going to do. So under this particular question we try to learn if control is acquired midway, how the accounting will be done. In the upcoming session we are going to pick up some strong questions to make you aware of a treatment such as abnormal losses, intercompany transactions, unrealized profit, and of course revaluation of assets, because these are the things which will affect the preparation of the consolidated financial statement. So we end up this session.